My name is Monica Twinar, and on behalf of the Center for Sustainable Global Enterprise at Cornell University's S.C. Johnson College of Business, I'd like to welcome you to the 7th Annual Cornell Business Impact Symposium. For nearly 2 decades, the Center has been conducting applied research and teaching on the growth opportunities companies pursue through competitive strategies that address the world's most pressing social and environmental challenges. We offer a number of programs, events, and activities for residential students, and we are pleased to be launching an online sustainability curriculum through eCornell for the general public in the coming months. We are excited to partner with eCornell to host this online symposium, which is only possible because of the hard work of a number of people who deserve recognition. First, thank you to my center colleague, Sophia Abdulhamid, for all her efforts that make this possible each year. Also, thanks to the students from the 6 graduate and undergraduate clubs that collaborate with the center to organize CBIS. Finally, I especially want to thank Sophia Petrula with the Global Network Club, who worked so hard to conceptualize today's panel and made it a reality. It has been a real pleasure working with her on this panel. Today's panel, Fintech, Increasing Global Accessibility to Financial Services, is the last panel in the symposium. With that, I want to turn it over to Sophia, who will introduce today's session. Sophia.
Thanks, Monica. Welcome all, and thank you for joining us for today's panel discussion, Increasing Global Accessibility to Financial Services through Fintech. This panel has been organized by Cornell Global Network, an undergraduate student community passionate about engaging with global issues and perspectives through tangible projects, collaborative events, and development opportunities. This panel will focus on the advantages of Fintech and its ability to reach underserved individuals and small businesses on a global scale. We have an incredible group of panelists from across the Fintech industry, involved in everything from financial inclusion in emerging markets, eradicating poverty and reducing inequalities through financial services, and strategy for innovative customer interactions. Our moderator for today is Dov Marmer, a Fintech lecturer at Cornell and the Chief Operating Officer at Railsbank North America. Dov is a 3-time Fintech platform exec with a passion for building tools that power innovators in financial services. Dov has experience leading 2 of the forefront B2B Fintech platforms and has built multi-million-dollar partnerships with companies like Uber, Intuit, Stash, as well as several publicly traded banks. I will now pass it off to Dov to introduce our panelists.
All right. So maybe able to build Fintech, but I can't turn off the mute button. Thank you, everybody, for having all of us today. It's really a pleasure to be here. What really gets me excited about everything that we're working on here is Fintech platforms, which is the area that I've kind of grown up in. Basically, is creating an AWS or a Shopify that allows any company to create their own financial products. And because we've now automated so much of that infrastructure, it allows so many new business models and so many new entrepreneurs to bring new products to market, focus on their specific niches. And today we're going to talk about a lot of the innovations that are coming to lending that are helping reach formerly underserved areas of the market. And what companies are building is actually truly amazing in these different segments. So we have some really, incredible speakers today, panelists, and I'm going to go around and let them introduce themselves because they'll do a way better job than I will. But let's go ahead and start with Jamai.
Great. Thank you all for having me here today. My name is Jamai Makarioki. I'm based in Nairobi, Kenya. I work for MasterCard Foundry. I don't know if everyone is aware of MasterCard, but basically we've got 2 arms of MasterCard. So you've got MasterCard, the business, and you also have MasterCard Foundry, which is basically the innovation hub of MasterCard, where we work on different innovative products using different technologies. And the purpose is to de-risk the larger MasterCard organization. So very happy to be here.
Pleasure to have you. And next, we're going to go over to Kizom.
Thank you very much, Dov, and hello to everyone. It's great to be back at Cornell. My name is Kesom. I work at the Chief Digital Office at the United Nations Development Program. I lead digital programming across our organization, and our goal really is to ensure and work together with partners to make digital an empowering force for people and planet. I have had the privilege of leading the UN Principles for Responsible Digital Payments, which was launched last year by a number of UN leaders, as well as a number of government leaders, including the finance minister in the government of India, who launched it at a global fintech festival, talking about a human rights approach to financial inclusion. Pleasure to be here. Thank you so much.
Pleasure to have you. And last but not least, Anu Meha, please introduce yourself.
Thank you, Doug. Hi, everyone. It's great to be back. Have great feelings with these sessions. My name is Anu Meha Rai. I work out of PayPal in San Jose, California. I own the homegrown behavioral analytics portfolio at PayPal, and you can imagine that to be the engine that powers the airplane that is PayPal. We support all our PayPal initiatives and programs by providing them with data on how our customers are interacting with our products, and then helping them derive insights on how they can customize and tailor their products to customer needs. So just looking at variety of markets, variety of customer types, and creating more tailored products is the goal that we serve. And happy to be here.
Pleasure to have you. So without further ado, we have some prepared questions for the different panelists that are going to dive into the topic at hand. So without further ado, let's get started. So first question, fintech lenders have substantially expanded the small business finance market by extending their services to borrowers unlikely to be served by traditional lenders and businesses in their growth stage who are less profitable. How are fintech lenders reaching these traditionally underserved customers, and what is the impact on their business? And let's start with Jemima for that one.
Great. So when you think of MasterCard, I think the first thing that comes to mind is card business, right? And what we are striving to do here in Nairobi, Kenya, is actually branch off our typical card business and work to include the financially excluded lot, which is the larger majority of people in, LAC, AP, Africa, Middle East, etc. So the product that comes to mind with that question is one that we built here a couple of years ago called MasterCard Credit Product, which basically serves the SME market. And what we did there is we looked at this typical mom and pop type of shops, very small shops, underserved. Most of them may or may not have bank accounts. Traditional financial institutions are not quite interested in them, not so much because of, you'd think it's maybe their volume and the value that they bring to the bank that isn't quite interesting to most traditional banks. So what we did is that we came in as MasterCard and tried to figure out how do we help the bank serve this type of merchants. So what we did there is we looked at the people who already know these merchants very well, which is the suppliers, right? So the likes of Unilever, the likes of Procter & Gamble, they serve these merchants on a daily basis. So we looked at that data, and what we wanted to do is use alternative data to provide a credit scoring mechanism to the banks for them to then lend to these SMEs. So what we did is we then went ahead to launch, and we did our first launch in Egypt, whereby we worked with Procter & Gamble. They had all sorts of merchants in a city called Alexandria, and they credit scored them on the basis of their invoice. So I've served these merchants for the last 6 months. This is how much they buy from me. Can I share this data with the bank, and will the bank be willing to give them credit based on this data? And that's the channel that MasterCard came in to bridge. So we shared this data with the bank. The bank looked at the data and said, hey, this is good enough for me to offer credit to this merchant. So I think the idea here is to just use alternative data. Typically, a bank would look at your balance sheet. They would have to look at your how much you bank on a daily basis, on a monthly basis, for them to assess whether they can give you credit. What we were giving them is alternative data that they can look at and still be able to give these SMEs credit. So that's just one example of some of the products that we've had to look at and bring to life to serve the underserved.
Really interesting. Some great innovations there. And Kaysam, we'd love to hear from the United Nations perspective about, I'm sure you have tons of initiatives going on in this space. Tell us a bit about what you're doing in that segment.
Absolutely. It's great to hear from Jemima about the use of alternative data, and that really is the key piece of the puzzle. However, we also know that some of the enabling environments around the use of alternative data and who has access to it are also challenges that inhibit much of the innovations that get piloted to really scale up. We also know that that fintech has generated a lot of hype in the recent couple of years, but there's also a significant amount of confusion around the fintech ability to solve for financial inclusion. We know that there are a number of new business models, new companies and products that are transforming sort of, how value chain is digitized, and thereby sort of the enabling role that access to financial services can really have in terms of the income generation opportunities, and credit is a key part of that piece of that puzzle. But we also know that the link between these innovations and financial inclusion, in terms of particularly making it a meaningful financial inclusion, is often assumed rather than proven, and it's because the understanding around the user's needs, particularly the low-income users that we're talking about here, the 1.7 billion people who are still without a bank account, who are, and even more who are underserved. The approach to the unlocking the potential of digital credit, particularly in the context of fintech, I think is within sort of this broader opportunity that we're seeing at the country level and across the world in terms of that inclusive digital transformation approach, where access to connectivity, access to devices, access to the ability to create alternative data sources are some of the fundamental and foundational building blocks to really scaling up then the offers of digital credit. On the other hand, also making sure that digital credit, beyond the pilots, can really scale and offer that level of security, that level of trust for the users or the marginalized segments of the population. From UNDP, we recently launched a Digital X Innovation Scale Challenge, where we're inviting a number of partners from a number of markets to partner together with the UN to really solve some of these complex challenges. And certainly, as part of our strategic plan, we have a moonshot goal of $1 trillion financing unlocked to help achieve the Sustainable Development Goals. And I think sort of making those broader linkages while colleagues like Jemima and others work on those specific solutions is really key to this big question that you asked of.
That's some great perspective. Interestingly, we're doing some things, even on stateside. So Railsbank, like one of the products that I've been working on, is a turnkey platform that lets any company issue its own credit card. So if you guys have seen the Apple Card, it's essentially Goldman on the back end, but Apple builds the entire experience in their app. And one of the problems you've always had in that segment is banks traditionally only lend to you if you have a 700 plus credit score. But what about this entire other segment, kids just out of college, people who may be underserved, right? And really the problem was access to the different tiers of capital structures. So like one of the things that we've done in there is to say, if you're a Robinhood or a Wealthfront or a Macy's or anything, right? Really, like what you want to provide to your customers is a seamless user experience where credit is just a part of the journey. You don't have to kind of break it up and go somewhere else. And in order to facilitate that for a wider group of customers, what you really just need to do is bring different investors on the back end who want to lend and provide balance sheets to those different tiers of customers, because hedge funds might want to go to take a bigger risk profile. Right? Banks might want to take a lower risk profile. So a lot of the fintech automation that we're able to create on the back end to say, this card is tied to this facility, this card is tied to this facility, it allows you to serve a much broader spectrum of customers, where typically high-end credit cards were high-end and the low-end was low-end. Now everybody can have that same fantastic user experience or being built out by tech companies.
I hope they're using MasterCard.
Boom, there you go. You are a partner. So next question. So globally, fintech lenders have leveraged a combination of business models, technology, and innovative approaches to reach remote areas and unconventional customers. Please expand upon the problems your company is addressing and your approach to solving the problem. Asked a different way, also, how is fintech expanding globally and appealing to a market experiencing a different set of challenges? So we're going to start with Jemima on this one.
So my outlook is certainly different from most, right? So I'm looking at markets where, the larger majority is underserved, right? So it's not even so much about lending. It's even just about having access to financial services, right? Even just having a bank, or having an account where you can, as an SME, for example, going back to that SME example that I put forward earlier, where you don't even know how much you're making, right? For you to assess whether you even need more, right? So I think the first step for this type of market is really digitization, and that's what we're striving to do with some of the products that we're striving to launch in this market, where you take in a typical mobile phone that can help, again, going back to the SME, an SME to be able to record transactions that happen on a daily basis, so that then they know what runs out, right? And that's the only way they can grow. If I know that I run out of, say, milk by 10 o'clock, I should be able to ask for more milk because I've digitized the process. Right now, they have no clue. They don't know who they give debt to. A lot of the small shop, mom and pop type of shops give debt to their customers. So if I'm not recording that, then I probably don't know I don't know how much is out there in debt. So I think it all starts with digitizing this whole setup. So even for a school setup, for example, if I'm receiving payments through cash, how do I know how much I've received so far? If I'm using Excel or maybe pen and paper to actually record, it becomes even harder. But at the same time, if this school is also running into cash flow issues, how do I share this information with a financial institution for them to then come back and say, hey, I could loan you this amount of money to settle your cash flow issue? So I think from my part of the world, it's really, it has to start with digitization and then move into ways in which you can lend.
Very good. Yeah, because I think also technology just drives down the cost, right? If you can automate something through software, you can provide it for lower and lower cost to consumers. I think also just really interesting in the US as well is that like all the VC capital is being poured into the space. Most of the startups actually have a time horizon where they don't care necessarily about profits. They care about just growing their revenues and their active bases. And that general kind of market dynamic just also, again, drives down costs. That's why you see all the no-fee bank accounts. It doesn't cost nothing to run a bank account, right? But companies are willing to subsidize those to build up their customer bases and then kind of provide more services down the line. So Anumeha, the next one, just that same question over to you is, if you can expand upon the problems your company is addressing and your approach to solving, getting capital in those different areas.
Absolutely. I think being a two-sided marketplace, right, where we are connecting end consumers and merchants all together, we have a great opportunity at PayPal. And more so on, the approach that we get from our leadership. Our CEO, Dan, has been great. He has a history of understanding underserved communities, and we as an organization are putting in additional efforts to actually reach those markets across the board, be it consumers or be it merchants. I think, we know that there are 70 million Americans who are working outside a traditional financial system. And even just US has such a big population. And if you go to more developing areas, this grows exponentially. Being able to support these customers, being able to help them do their transactions think about this. Paying an electricity bill right now in the US requires some kind of a credit card. I mean, we have a 3-day training when we join PayPal as an organization, and we are supposed to just live life as a person who does not have a bank account. And you see the challenges people are facing, wherein you have to get a cash card, you pay 2%, 5% fees, and so on. So really understanding the challenges of these consumers has been the key, and then building products to support their use cases. Think in the lines of Venmo credit cards. You create a Venmo account, you get a credit card. It's helping you a lot, right? You get your paycheck through Venmo. You can share money with everyone. That's on the consumer side. Think about it on the merchant side, right? You have a lot of small businesses who want to offer more capabilities to our customers, who want them to use their products more. But how does how does a business in Australia reach out to a customer in America, right? How do we get there? So PayPal has been spending quite a lot on driving initiatives like these. We are working across the globe with a lot of local partners. Think of from Australia, I can remember we have Welcome to Country, a program where we are supporting the Aboriginal merchants. They want to do transactions globally, and we're just providing them with the right set of platforms. Just offering loans, I think credit check has been a big challenge. So offering working capital with minimum credit check, relying on PayPal transactions as the basis to derive a credit score, an alternative credit score, has been one that we have really been pushing, so that merchants who might not have an extensive financial history, who might not be as profitable as these big merchants like Nikes of the world, they are still able to get the required capital they need to grow. I think that has been a really big initiative. Our launches, the business debit MasterCard across in Europe with Belgium, Finland, supporting businesses through these different programs, and also ensuring that, especially in COVID time, we saw that merchants who were at the ground locally, they wanted to do transactions, but with COVID, with people being scared, it was getting harder. So giving them tools like a QR code or a Zettel transaction check, it just helps doing the touchless payments even more. So we are trying to focus on multitude of areas, both on consumer as well as small businesses side, to provide products and to provide money to grow these businesses. And I think it's taking a turn where now people across the globe are able to interact with each other and do transactions, and it's really helping our communities. As a consumer, if you think, right, I buy stuff from India, from really small merchants who I would have never been able to communicate. I get a great product, and the business is growing. It's growing global. So it's great. I think the way we are operating now.
That's super helpful. And you stole half of my question, but I want to put one a little bit to Kaysum. So we were just talking about, the use of alternative data sets to kind of help underwrite consumers that don't have access to traditional data sets. What are some of the things that you're doing to help support those initiatives?
It's a great question, Doug. Thank you. I think from at least what we see globally is a number of really important discussions converging around, sort of having a very intentional approach to some of the new and emerging sets of technologies that are kind of reading these data sets, or even producing these data sets, from artificial intelligence to how algorithms are written and applied. And I think that level of intentionality and that level of discussion that's really sort of picked up momentum at the UN headquarters, or within the European Union, or within ASEAN, or within the African Union, I mean, it is tremendous. And I think we are all asking the right set of questions, which is basically, how do we ensure that digital does not lead to increasing inequalities, how do we ensure that digital does not lead to some of the harms that we see happening on whether social media platforms or other aspects of digital? And how do we protect people who are vulnerable, who don't have agency and voice, as we, take digital to them as part of empowering, as part of creating opportunities in some of these emerging or low middle income markets? So I think that level of intentionality, that level of human rights-based approach that is being applied to technology and its use of technology is a really important one that's picking up great momentum. From the UN Secretary General, there is a broader digital cooperation roadmap that identifies some of those values, that anchors some of those important discussions. Under the Secretary General, there are also other coalitions around how to interpret, human rights in the context of digital rights, and really taking, really sort of asking the right questions. I'm not saying we have the answers yet, but applying that level of accountability frameworks and safeguards, both in terms of how policies are imagined, how regulations are imagined, but also how technologies are finally built and deployed and used by the user, I think will require a very cohesive approach, a cohesive dialogue where we continue to learn and minimize harms and really sort of maximize the potential of digital for that inclusivity, for that financial inclusion that we're talking about. So I hope that answers your question, Doug.
It did. You did a great job, and you answered that in my next question. So I'm going to skip one and just go to a new one. So the next one, fintech lending is recognized for accelerating processing times, increased elasticity to demand shocks, and decreasing human errors. For small businesses, that means that quick access to capital with lines of credit approved within a matter of minutes. What do you consider the greatest advantages of fintech lending for small business and or underserved individuals? And we're going to start with Jamai.
There's a bit of, okay, much better now. I don't know if I'm the only one who's hearing that. Can you hear me okay? Oh,
I was on mute, so I guess you didn't hear any of that.
No, I did.
Okay.
I did. So I think the question is on instant disbursements of credit, isn't it? And the impact of that.
Is that fintech lending has basically provided a lot of benefits to the market. So some of the things we called out were faster processing times, increased elasticity to demand shocks, and decreasing human errors. Right. So really, it's about how fast we can get the money to the places that it's needed. So what do you consider the greatest advantages of fintech lending for small business and underserved? And how is that different than what the banks are doing?
Yeah. So in our market, there's an MNO-led sort of fintech boom, if you want to call it, right? Where you have mobile network operators coming into the space that banks have occupied for a long period of time, and lending to both individuals, to SMEs, to merchants, all types of merchants, and all of it is instant. So a typical, supermarket, for example, or say, for example, a shop would be out there looking to get a loan from a bank. And what they'd have to do is leave their shop, close up their shop, go to the bank, apply for a loan, and submit all sorts of documents for the bank to look at it and assess whether, they're worth a loan. And in most cases, the bank would then send someone to go to the shop and, to assess and validate that the shop, yes, exists. They are selling what they say they're selling. They are who they are. So there's a whole bureaucratic process of actually giving out this loan. And what has happened in the market since the rise of M-Pesa and, the Airtel monies of this world is, you no longer need to go through all those processes, right? So all I have to do is come in and go to my phone, either on USSD or my mobile banking app or mobile app, and all I have to do is submit information that the MNO would ask me. So, my ID, perhaps the details of where I live, etc., all the KYC details that are required. And at that point, they do their own checks. And the beauty, and we spoke about non-traditional data, what they use on their part is GSM data. So I've been a subscriber of, say, this particular mobile network operator for the last 10 years. They already know how many calls I receive, whether I get international calls and things like that. And that's the kind of data they use to credit score you. And they're able to disburse this loan within minutes. So this has been the phenomenon that we have in this market, whereby fintechs have replaced banks completely in regards to getting credit. So a lot of individuals, a lot of shops, mom and pop type of shops and SMEs are relying on the likes of M-Pesa, Airtel Money, MTN Money, which are MNO-led fintechs, so to speak, to actually get credit. So I think for me, it's almost made banks irrelevant. And if they don't do something about it, and most of them are trying to do, trying to emulate and even shift completely to digital, where they can actually give out these loans digitally as well. But if they don't move in that direction, then there's a fear of disintermediation.
Yeah, I can add something there. So we've been leaning in heavily into this world of we call it embedded finance, right? Which is basically put the financial products where the customers already are. Don't make it a disaggregated user experience. And that's really what you're talking about here is customers have phones, right? Banks are terrible at acquiring customers. Like they're actually really bad at that piece of the puzzle, but they're very good at managing risk. They're very good at raising capital. They're very good at understanding regulation. Like they still have a really important piece of the puzzle. But I think what's kind of happening in fintech is you are disaggregating the different pieces and creating specialist organizations in each area of the supply chain. So for example, like in our world, we orchestrate all of the program management layer, all the different pieces that need to integrate to create a financial product. But there's still a bank on the back end who manages the capital and the regulation and all those elements, and they're still really, really important to the process, right? But they don't necessarily have to build their own set of APIs for the customers so that they can build digital experiences. That's not what they're good at, right? And also, same thing for our company. We're not the front end to the consumer. We'd rather partner with someone who already has 1 million customers, right? And say, oh, well, here's the financial product. Now it's embedded inside and everybody's happier in that whole situation. So it's really just an exercise of, can you create real partnership and create real value? And I think getting away from that old view of traditional banks, is you're my competitor or you're my vendor and I just want to own everything. Right?
Correct.
Just changing the world. And I'm sure that PayPal has a perspective. So I'm going to go to Anumeha on that next.
Absolutely. Absolutely. Sorry, go ahead.
I was just gonna. It reminded me of a story that I read somewhere about Willie Sutton, a famous American bank robber who was once asked why he robbed banks, and he said that's because that's where the money is. So just to say that there's such an important role still for banks, but it's really the fintechs that have kind of figured out innovation around distribution models and the customer interface that seamless customer interface that W spoke to. Anyways, sorry, Anumeha, back to you.
No problem, Kizan. I think this, it really plays into what I do on a daily basis, and I'm always very excited about it. One thing that I've seen happen in PayPal throughout the years is with the number of acquisitions we've done, we are focusing a lot more on understanding customer end to end and then trying to offer complementary products. Last year I think we acquired Honey. So think about a customer who's trying to do. I'm a customer who's trying to buy something. I will first try to figure out, okay, where is the product available online? I have an access to the phone, as everyone said. So I'll see 5 places. Then I'll decide, okay, where is the best place to buy? Then I'll probably go and make a payment using a credit card, PayPal, or whatever. But like every step, there's a lot of hindrance. One, how do I discover where my products are? Where is the best place to buy? And PayPal, with the first acquisition we did last year, Honey, it is really facilitating that. You download that plugin, and on a single screen, you open the product you're interested in, and they will tell you exactly what all marketplaces have that product and what's the pricing, how has it been over time. And what that helps a consumer do is then you can kind of judge on how do you want to make your purchase. Now, as an organization, we take all this data on how customers are purchasing, what kind of transactions they're doing, and then we can look at it from a bigger picture. What are most of the customers purchasing? What kind of information are they requiring to make a purchase? And then we can offer complementary products. What we have done as a behavioral analytics platform in PayPal is we are trying to understand user experiences across all our products. So how is a customer who's interacting with checkout using PayPal making a cross-border transaction using Venmo, using Zoom? And then we are offering complementary products like working capital, business loans, buy now, pay later transactions, wherein what we are doing is, hey, we know you are a customer who has a small business, who was getting money paid through Venmo, who was paying their suppliers through PayPal. We will offer you a $10,000 loan so that you can grow your business. Does it make sense to you? So with these initiatives that we are running to collect insights across the board, it's really helping drive that unique, cohesive customer experience for us. And that's what I work in, so I'm always excited about it. The other thing I think what we are also doing that's really helping these underserved individuals is offering working capital. One of the biggest challenges, besides credit score is, can I make flexible payments? Like, I'm running I'm running a shop to make diyas that happen in India, and that's only sold during certain times of the year. But my production is going on throughout the year. I'm prepping for that particular time period. Now, what happens? I don't have the money to pay $5,000 or $2,000 each month. Can an organization come in and say that, hey, we understand your business model and we are willing to offer you a product where you can customize your payment depending on where you are in your life cycle. So if you're in production phase, hey, go ahead, don't make any payments, no problem. When you start selling, we'll take a portion of the revenue and that'll act as your payment. And we are not going to charge you very high interest. It'll be a very fixed payment. It'll be very affordable, and that opens up the avenue for so many small businesses to grow, because now they no longer have to go to a traditional bank and have to be tied to those high payments that they have to do every single month, no matter how their revenues are. I think that to me is a very, very big initiative that helps these businesses grow. And I've seen that over the years. I've been here at PayPal for 3 years, and we have seen the amount of small merchants we had grow exponentially because of these capabilities. We also offer a buy now, pay later solution, something as simple as saying that, hey, you want to buy something right now, but you don't have enough capital to pay everything in one go. Can we break the payment down for you? It'll just help ease the burden of the customer. Rather than making it in one go, you might pay it in like 4 months or 6 months. So these products really help simplify the journey the customers are going through, and also from a business side, help them grow by offering them more customers now that they have the flexibility to, pay off the loans they're taking.
Yeah,
I hope that answers your question.
I wanted to just mention something just in relation to what Anumeha just mentioned around repayments. In most scenarios, especially like if you were thinking about banks, they would expect you to pay, say, monthly, right? And the one thing we found out as we were trying to launch a gig product is that certainly a gig worker, for example, would be earning on a daily basis, right? So when you give him credit and wait till the end of the month for you to charge him a large chunk of cash, it really doesn't make sense for that gig worker. So some of the ways we're trying to address that is per day billing. So if I know that the guy makes, say, $10 a day, they'd be able to be deducted a certain small amount that day. That way, you're not trying to set them up for failure at the end of the month. So yeah, so you've got to be considerate about that. And I think fintechs are doing a great job at that.
Absolutely. I definitely agree with Jemima on that. I think when we talk about underserved customers, the biggest part of that is a customer who does not have a lot of money sitting in the bank to make major transactions. How can we support people who are running paycheck to paycheck, or who are just getting paid in cash, which happens in so many parts of the world? How do we support those customers? As I said, right, we as PayPal, and on the 3-day training, we are told that, hey, you have to pay an electricity bill, you have to buy something for your kid, and then you have to register the kid to a class. And I'm trying to figure out, okay, I have $20 in cash, but how do I pay a bill? Like, they only ask for a credit card. Now, what do I do? It's very interesting how these fintechs are now looking at these customers and trying to figure out what their problems are to solve them a lot better.
Yep, makes a ton of sense. Okay, so let's go to, and actually, I wanted to just touch on your daily transactions. So one of the big things that I'm hoping somebody builds is, the way that you become wealthy over time is to always pay yourself first, right? And that's the idea of 401k. Let me just pull money off my paycheck, put it into an account. But that same methodology doesn't usually apply to day-to-day spend, right? But if you think about it, if I was able to tip a barista on a $5 coffee, I tip him $1, right? That's a 20% tip. Why can't I tip myself 20% on transactions all throughout my day? And because the psychological elements of it, at the beginning of the month, if I'm going to put away $200 in my head, it's like, well, I need the $200. I don't know. Okay, I'll procrastinate, right? Versus if I just bought a coffee and I was like, I'd probably invest 100% of it. I'd invest another $5 right there on the spot, right? Because those microtransactions are not daunting. And that kind of lends into human psychology of just to say, just invest a little bit all the time. So roundups, which was the first iteration, that kind of failed because like a nickel at a time is not really going to do anything for you. But if you can do percentages of every transaction from 10 up to 100, it will be materially impactful over time. And this is where fintech comes in, because embedded finance lets you put a bank account, a credit card, and an investment account all into the same app. And even though they have different regulatory structures underneath the surface, what the app layer can do is they can create, I got a webhook that I just spent money, send a webhook from my investment side that says, would you like to invest an equal amount in there? Trigger an ACH pull, put that into the account. So like all that really complex orchestration in the background can be solved through software. But to me, it's creating those changes in psychological behavior of pay back your loan every day or invest in yourself every day. You're just going to really be able to change people's lives through simplicity. So go ahead. Sorry.
As you come to the next question, I was going to say what you just described actually happens universally across the world in savings and lending groups across the world, whether you call it Osusu, whether you call it, VSLAs, whether you call it Rotary clubs. I think, the ability of people to be resilient and practice lending to each other in circles, saving together in circles, and creating that portfolio approach to that has been tremendous. The question really is, when is fintech going to be able to digitize that? And Doug, you just mentioned a really important point of the flexibility of that design. If I want to do 5% versus 20%, if I want to do $1 versus $5 or versus, 100 rupiah. So I think there's such incredible opportunity. We're just getting started.
Yep. And so here's an interesting stat. I ran the numbers because I was just curious. But if you get 2% cash back on $1,000 in spend a month, which is the US average that people spend on a credit card, over 10 years, it's worth $2,400. If you tip yourself 10% and get 1% cash back, that same transaction layer will get you $18,400 over the same time period. So you just see the impact of everybody chooses their credit card because of how much cash back it gives. But if you actually look at the reality of what that's worth, it's just a marketing thing, right? If you spend $1,000 a month, 1% or 2% is $10. It's a sandwich. Who cares, right? But if you can actually create those behaviors, right? So yes, still do the 2% to get the hook, right? Because that's how people buy. But like once you actually get them into the ecosystem, like actually, if you're in a wealth creating app and you see the value of your wealth going up every month, like that's the thing that's going to have you stay and keep up with it. It's not going to be that extra $10. Okay, last question. So some of the vulnerabilities of the fintech industry include the susceptible or naive impulse of consumers to overborrow, concerns about government regulations, and lower customer satisfaction regarding high interest rates, unfavorable repayment terms, and low quality credit loans with suspicious features. What do you see as the greatest challenges for fintech in this area, and what are you and your companies doing to overcome and mitigate some of these concerns? So I'm going to start with Jemima.
So this is a growing concern in our market, only because digital finance is so big here, particularly because it's led by both fintechs and MNOs as well as banks. And they've been out here, sourcing the same customer, Jemima. I get messages all day round asking me to borrow because there's no shortage of borrowing avenues digitally, right? And what has happened is that a lot of people have gotten into a hole where they're unable to pay back. And so if I borrow today from, say, M-Pesa, for me to pay them back, I'll probably take another loan from a different company, pay them back because I'm due. And then at that point where I'm due, so it's almost like a rotation of just debt. And it gets so bad that you have people who are living now in debt. They have to switch off their phones, probably get new phones because their phone is their unique identifier for these companies. And others are even auctioned. So it's gotten to a place where it's not ideal at all. And it's actually a concern from a CBK level, which is our regulator, Central Bank of Kenya level. And it's not just a Kenya problem, right? It's an emerging market problem where people have discovered digital lending and they've overdone it. And when you think about the kind of interest rate that they're charging these customers because of the ability to get it instantly, a customer would say, you know what, it's fine for me to pay 2% per day, which is like the average in Kenya for a digital loan. So I think there really has to be, I think it would have to be a government-led effort where you put controls on and this is something that they're already starting to do, put controls on the companies offering this lending capability, and at the same time educate. There's a bit of financial literacy that's required from a consumer point of view. Help them understand that taking a loan is not the ideal way of solving each problem. Because if someone, and this is something we've seen, the younger, like if you look at the younger segment, the people who are taking loans, they're not taking loans for anything significant. It's to either gamble or to party. So it's not uplifting their life. So it's really, I feel like it's not, the banks have a lot to do with the fintechs themselves, but because they're making money, it has to be a government-led effort where you put policies, you put regulation, you put controls in place to slow down the rate of lending to this particular lot. It's interesting, just the other day, the chairman of M-Pesa, Michael Joseph, I don't know if you guys are aware, he actually put out an article which said that he is not happy with where M-Pesa is going. And in particular, one product called Fuliza, which is an overdraft product. And it's crazy because at the moment, for every second, there are about 300 people borrowing, every second. So it's gotten out of hand. And what he was saying is that when they were building the product, it was supposed to be a savings product. So it was to allow people to have a savings culture, which is something you don't get in emerging markets. And what happened now is that people save to borrow and they overborrow. So there's a borrowing spree going on. So it's really a concern across board.
Makes a ton of sense. Actually, that's something that we are thinking about a lot. So we built a platform that lets any company issue its own credit card, right? But I think everyone on our team is saying, like, our dream is actually to lower the cost of credit cards, right? How can you actually make a credit card a financial product that would be healthy to revolve on? So one of the things that we've been doing, which is an interesting new innovation, is this idea of asset secured credit. So one of the reasons that you have 15 to 30% interest rates is because you're basically giving somebody money. You're underwriting them as an individual and hoping you're going to get it back, right? And the people who default are basically costing everybody else more money of the people who actually pay back their loans. So if you look at the economics, like, they're not making that much money at the end of the day. I think, the big banks make 5-6% net. So it's not like anything that crazy that they're doing, but that's what's facilitating this high cost of capital. So what's interesting, though, is you have, like, in the segment of crypto, you have people that maybe invested $1,000 at the beginning of crypto now have $100,000 in crypto, right? So they're well in the money, right? So it'd be very taxable if they actually sold it, right? So, and this is why people don't spend crypto. So lots of people have launched debit cards only to find out that nobody wanted to spend because they wanted to hold the asset. They thought of it as more valuable than cash. So asset secured credit is basically this question of, could you actually, if you had 100,000 in crypto, could you give someone a $20,000 credit limit credit card? But instead of underwriting the individual, you underwrite the asset. And that asset is held in security, right? The person can pay it back because they have the money in an account, but you're just not making them sell the asset. They can actually keep it there until a certain trigger event, whatnot. But like, that is actually a way that you make cryptocurrency spendable without taking the one benefit away that people don't want to sell it, right? And then, as they get their next paycheck, they can pay back the credit card as you would any sort of normal thing. Or, if you underwrote the asset at a 20% LTV, you could probably give that individual a 5% interest rate on their credit card. So if you needed to revolve 1 month, okay, 5%, your crypto is probably making you 10%, right? So people can actually make, financially healthy decisions. So that's kind of where we see the world heading, is actually being able to combine securitization and cards at a micro level to be able to kind of do that for individuals. Because today it is available for high net worth individuals. So like, the billionaires at UBS can do this with their stock accounts all the time, things like that, but it's not available to everyone. And fintech can bring that barrier down. Kaysam, you were my other panelist to talk to that question. So just to repeat, if we went way off track, right? But what are the challenges of fintechs getting into high interest lending, and what are you seeing in terms of companies helping to mitigate that risk?
Doug, I think I can certainly speak from policymaker and a regulator's perspective. I've spent a number of years in different central banks, seconded to them. And I think overall, there's been many different ways in which, regulators have responded by trying to create a sandbox environment or an innovation environment around fintechs. In fact, in Sierra Leone, the Bank of Sierra Leone was the first central bank in the West Africa region to have a thriving live sandbox that, finally was able to accept 5 new fintechs to kind of really move the needle on financial inclusion. And it was really remarkable to be part of that journey at the bank. But I do think that the regulatory parameter itself needs to be reviewed and perhaps even refined, because there is, more cybersecurity concerns, new sort of kinds of risk management capabilities in, less risk management capabilities in the new types of startups or fintechs that we're seeing. And therefore, I think, we can certainly, there's certainly a need around more robust consumer protection, more robust data protection and privacy and competition laws locally in many of these markets. And of course, that, hand in hand with that goes the growing need to better equip then the regulators in these markets to deal with the challenges ahead. And this is often overlooked, by the sort of broader fintech ecosystem, because I think this is where, if we want to protect the gains that fintech has made in financial inclusion in the recent years, and really kind of move from that piloting to scale, and in some markets, as we heard from Jemima and our colleague at PayPal, it's there are instances of scale. I think the role of regulators and policymakers is going to be of critical importance in terms of ensuring that robust focus on consumer protection and people at the end of this tunnel of light. I think you're on mute, Doug.
I said, I'm going to play devil's advocate to have some fun as the moderator, just to kind of throw out an alternative point of view. So some would say that regulation, while the intent is correct, it actually serves to stifle competition within the market, right? So basically, the high regulatory barriers of bringing a new product to market actually means that, the banks are usually the ones pushing for all the regulation because they can afford it. But actually, in a market where there are more lenders, in a commodity like money, having more competition, the free markets might actually bring down the cost of capital and provide far more access to individuals than if you're kind of keeping it in the hands of a few who then control the price. How do you guys think about balancing competition and regulation to create that right balance?
I think if I were to speak about sub-Saharan Africa and like how the fintechs have grown here, what has happened is with every new product that's come in, it's been outside regulation. So it's almost like regulation sort of has to keep up with every new product that's coming out, including the bank products that are also coming out. So it's interesting. The thing, what I've seen with our regulators is that they know that they're a bit behind in terms of their thinking. So what they do is that they let you go, and then as you're moving forward, like from a pilot point of view, before you scale, they try and see how do we then control this so that it doesn't harm anybody in the future. So they're a bit lenient. So in terms of like launching of products, like most of the products that we've done with our partners, we go to them because there's no clear regulation around it. We go to them, we explain to them what happens. They come, they view the system, they go to the back end, they understand it, and then they give you a letter of approval, which is sort of like an in-between license that lets you start, right, as they observe, and then eventually, as they figure out their regulation, can give you a license against it. So they're very aware that they're behind in terms of, regulating fintech products.
It sounds like a really valuable approach. So in my last role as the moderator, I do have to keep us on time. So I want to thank all the panelists for their insights and thought leadership here. This was a great discussion. And let me pass it back to anyone from the Cornell team that wanted to provide any final remarks. Or I can represent Cornell team and say thank you all for joining us today, and hope to chat with you all again soon. And please follow all of us on LinkedIn, Twitter, social, so we can all stay in touch. Thanks.
Thank you for having me.